Ron, you last week were starting to talk about what you see as a major change in the, let's say, the context or the backdrop of investing, and that is how both Fed policy and fiscal policy are now favoring Main Street over Wall Street. Explain what you mean and what the consequence is.
I'll handle the first part first because it's easier. But yeah, I do think, Tyler, that investors going forward are going to have to deal with what I think are profound changes, both in fiscal policy, which we began to refer to last week as a move away from a 40-year trend of trickle-down economics to bottoms-up budgeting that addresses the needs of Main Street over Wall Street. I think the Fed's policy decision and the Q&A session that Jay Powell engaged in this week, when they delivered their decision on interest rates, it was equally profound insofar as the Fed has now suggested it will not act preemptively, which has been the case for the last 40 years since Paul Volcker, to cut off incipient inflation. They want to see the data, not a forecast. So that is a wildly different position that both the Federal Reserve is in now and the fiscal policymakers are in. And I think if we start to see something like a modification of the filibuster or an end to it, policy will get increasingly more progressive from the fiscal side, more aggressive from the Federal Reserve side, and that's something that I think the markets will have to contend with. It's going to create different types of winners and losers. I think that part still is to be determined, but I think that Wall Street needs to really start thinking about what I think is a very important sea change, both in fiscal and Federal Reserve policy.
So money directly in the hands of individuals at the consumer level, as opposed to tax cuts that trickle down allegedly through the system. And number two, less concern about anticipating inflation, more concern about actually seeing it. I'll come back to you and ask what kind of stock groups might benefit on either side. But let me turn to Michael for your reaction to that. I know, Michael, that you believe that right now, in the face of a wobbly market here over recent days and weeks, perhaps, you say going to cash is foolhardy.
Oh, I certainly think it's foolhardy, but I always think that market timing, Tyler, is foolhardy. You know, I think that markets that were already feeling uncertain got kind of a wobbly and uncertain message from Chairman Powell this week. He said, you know, okay, the economy's growing, we expect inflation, and we're not going to do anything about it at the Fed. We intend to let it run hot, and don't you worry, Wall Street, everything's going to be okay. I mean, we're used to hearing a plan from the Federal Reserve Chairman saying, if things get dire, we're going to be there. We've got a plan to go forward with here. We're not hearing that. We're hearing we've got to wait and see, and we're going to see what happens here. We've had $900 billion in stimulus at the end of the year, another $2.8 trillion in stimulus in a single quarter coming into this market. I don't know how you sit in cash when you see this much stimulus in a recovery, the vaccines, the everything else. Share prices are going up. Can the Fed actually keep on top of this, or will they stay at the party too long, and will they kind of lose control of things? I think that's the fear on Wall Street right now. We're also at that end of the quarter time where there's not a lot of news, and people kind of get a little iffy before you also get to April 15th, now I guess May 15th. But it's an iffy time of the year. We still need earnings headlines. We'll get them in April.
Shepard Smith here. Thanks for watching CNBC on YouTube.